everybody. Welcome to Friday, another Talk Money with Tom show. We're here to answer your questions. Go ahead and send them in now if you'd like. You can send them to the email address at asktom@talkmoneywithtom.com. You can put them into chat. And we're here to answer questions about your retirement planning, asset management, what the economy is doing, tax planning, any of these subjects. We really big believers that education, amongst the public in this particular case, really helps with a more successful retirement. And so we created this channel, Talk Money with Tom. You can subscribe to the channel, hit the bell button when we put out new content. You can got 1,200 and some odd videos at the moment, so there's some things that you can go look at there. Even if you have an advisor, we've found that the more somebody knows, it seems like the better they do as far as that goes. And of course, you can always just meet with us if you'd like. If you want to ask questions here online, you can go to our book appointment button up in the corner of our website. Looks just like that, and our schedule's live, and so you can pick a time, 30 minutes to meet with Ethan and I, and we can answer your questions directly. So looking forward to today's show. And thank you everybody for joining us, and hopefully somebody gets something good out of this today. So all right, do like starting off every show with kind of a summary of what we saw happening in the market this week, and I've got a kind of a different chart here. Let's move that Chiron out of the way because I want to talk about something that's under it there just for a second. Okay, so this chart goes way back. This is weekly data, and we can see kind of 94, or three sticking out. I'm really looking at 1995 because when I look at it's a pretty incredible pattern.
Yeah.
I mean, it's by the week, so it's a little less jagged, right? A little smoother. But that's a super smooth year. I mean, that was pretty much straight up. And I remember 1995 very specifically, and we keep getting kind of correlations to that year. Number of, the ratio of up days to down days is the same as 95 and et cetera. And I remember 95 very specifically, and it kind of does remind me of what's happening here. And there's a subject matter that seems to be similar too. So that was the .com, Hey, here's the internet and what it's going to do and the excitement around it. And here we have this artificial intelligence, and obviously we don't really know the full impact of what that's going to do, just like we didn't in 95 know the full impact of the internet. I mean, we're here on this show because of what happened in that time frame and able to broadcast on a channel like this. And the other thing that's similar to me is that in that time frame in 95, it was much more kind of a reasonable run because it was companies that had good earnings and bigger companies and had great sales and a product out there, and kind of a lot of the backbone of the internet pieces were moving, the Cisco's and Suns and such as that. And we're seeing that same thing now, in my opinion, with these kind of bigger companies, NVIDIA and Microsoft, and companies that might have now. Again, if you keep going past 95 and you look at what happened there, by the end the market was still moving pretty nicely, but a lot of crazy stocks were coming out.
Yeah, you can kind of think about like a gold rush where the the general stores are making the money early on, and you're waiting for the miners to strike it rich, which are kind of like the smaller companies. So you're gonna have some that strike out and some that actually do hit the mother load.
Yeah, exactly. I mean, it almost becomes sort of a frenzy, right? And I always tell the story about bingo.com. One of my clients that called me during that probably 99, 98 timeframe, and it was up, I think, like 800%, and they didn't even have a product. That they disappeared, shortly thereafter, actually, because they weren't allowed to do bingo online. Never got that approval, but that's the type of thing that I wouldn't be surprised to see happen again here with this artificial intelligence thing. Probably more like 2 to 4 years from now, before that happens. Takes time for this to take place. And I'm not saying this is going to happen, but when I look at the pattern for what we're dealing with here, since the end of October to now, it's pretty similar. Right? I mean, it's kind of smooth. It's pretty straight up. Again, we're seeing a lot of correlations here that are kind of fascinating. And so, however, you do have to understand, kind of how you work through these time frames, because, that .com bubble burst in the end and we had a 45% drop, those types of things. So knowing, when you start to see that mania, that you've got to, be a little bit more careful. I mean, we have a system of rotation within our, universe list. And when things start to fall apart, the things that are still working will be moving up to the top of that list, and we can rotate into those, including the possibility of even being in T-bills and those types of things. We actually were pretty much out of the market in 2001 during that a big chunk of that downturn that happened for the same purpose, just kind of on a rotational basis. So one of the things that was really kind of important this week, I almost want to call this inflation week because we had some, most of the motion is around inflation. So when we look here on Tuesday, the consumer price index was reported. And again, there's two pieces to all these reportings. Technically, there's like four because I got year over year and month over month. And then we got top line, which includes everything, and then core, where they take out food and energy, right? But I'm going to focus just on year over year here and core, right? And not the top line, because core is more of what the Fed will look at. So you can see this pattern's not terrible. It's not dropping substantially.
Yeah, it has bumps along the way down.
Yeah. So it says it's down. It's year over year. It's 3.87% for this basket, and the market was expecting better.
Yeah.
And so the market dropped 1.6% on Tuesday. Now I thought it was kind of fascinating because now we have the federal governors coming out kind of in support of the market, which is really fascinating. You got to pay attention to what they're saying to a certain degree because I feel like it's not scripted per se, but they have a strategy. And so if they're talking negative about the markets because they want it to come down, because they want inflation to come down, right? Mm-hmm. If they start talking positive about the market, which they've been doing more of, my feel is that they're feeling like, hey, we want the market to try to support a situation where we don't end up in deflation.
Yeah, that's a bigger fear.
Right? Well, I'm not sure it is, but if you listen to their words, it's a bigger fear altogether, yes. But I think it might be one of their fears right now, too. I mean, because just listening. So, for example, one of the Fed governors came out really on Wednesday morning and said, hey, look, the CPI is not the measure that we look at that much. The 2% target that we talk about is on PCE, and he says they're significantly different. But interestingly enough, the market doesn't seem to know that based on that 1.6% drop.
I think because the CPI comes out so much earlier, it gives people react much more to it. Though PCE comes out later, people kind of have expectation based on CPI and what's come out already for the month of January.
Yeah, that's true. It's and the market recovered in 2 days.
Yeah.
Right. Because look at that pattern. I mean, I thought it was kind of oversold on the downside that day. However, when the market gets running like it has been, it gets stretched out. You're much more susceptible to those pullbacks on a short-term basis. Just because the market, people take profits, which makes sense, and then gets down low enough, and you get your dip buyers coming in. So we ended up with a nice run back up, and came up. Yesterday we closed at a new all-time high, and gained everything back. So down Tuesday, back up Wednesday, Thursday. I think we had something similar to that the last time CPI was reported also. Again, there's some expectations that the inflation would be dropping faster, and it hasn't here. Today's report was the producer's price index, and the market, I don't know where it is right now, but it was kind of sitting around zero, just before.
It's down a quarter right now.
Down a quarter, okay. And this is the wholesale price index, right? And you can see it actually went up. It's up to 1.95%, and that was not expected. Mm-hmm. And so a lot of times the market is responding to what is expected because it's already baked in what's expected, and if there's an adjustment to that, it adjusts itself. However, when I look at this chart, first of all, it's up, but last month it was at 1.72%, which is pretty darn low, honestly. So to see it come back up and hover around 2%. Again, this is a lot to me like the stock market. You look at it sometime, you're like, okay, the market's coming down. Is this just a temporary thing, or is this like a big downturn that's going to continue? I think that's the same thing here with inflation. We see some little pops up once in a while. Is this, and actually, if you look closely at that, it popped up before, last year also, but and then it came back down. So, what's the overall trend and what's the momentum? You got to look at that chart. You got to say the overall trend's still down.
Yeah, and this report was interesting because goods was actually decreasing when you took and then you had services which was 0.06% month over month versus goods which was negative 0.2% month over month.
Yeah.
And so you can kind of see that divergence of service versus goods.
Yeah, and that's been an ongoing thing. It was just the opposite, right, during the heart of the pandemic because we couldn't use the services, so we were going crazy on buying goods. Got all kinds of ships out in the port and Long Beach and LA and whatnot, and that's now mitigated, and we're out doing things, and it's look at the amount of people traveling and what have you. I have some clients that are talking about doing some revenge traveling this year, doing some big trips. So one thing that happened also on Wednesday, the federal governor that was talking said that it would be completely consistent within their desires to get inflation back down to have a few months that were up. He says that's very much what they kind of expect to have happen as far as that goes. So let's look at, again, this is the core PCE, right? This is what this Fed governor is talking about. It's what Chairman Powell talks about when he gets asked questions after their meetings. He's talking about PCE, and he's talking about core PCE. And this is at 2.93%. They want to get this down to 2, right? And again, we talked about this before, but I still think it's worth repeating. If you take the last 6 months and annualize that out, we're at 2%. If you take the last 3 months and annualize that out, we're actually at 1.5%. And that's why I think this is where they're seeing the deflationary, hey, that's lower than we want, right? And that's why I think we're starting to see some comments. Now, we're still hearing comments like today from Bostic about, hey, it might be up, the rates might be up a lot longer than you think, right? Yeah. And I actually talked about this week, I wouldn't be surprised to see rates stay the same all year, or if they do come down, it'll be fairly late. And the market is now, it had baked in a cut in March, and that's gone.
Yeah.
It had baked in a cut in May. That's now gone.
Yeah, it's all June's the first time
now,
where they
June is the next. So it just keeps going because the numbers that are coming out are showing a decent economy. Now, we did see this week some softening retail sales, which ironically is a good thing in an environment where everybody's worried about inflation. So we'll see how that plays out. And we are also seeing internationally, countries that are ending up, Japan is now in an official recession. China has been having problems. China is having deflation and, stock market issues and what have you that are happening there. So you kind of wonder, there's another country in there, I can't remember which one of the European countries that also announced they have a recession that started this week that came out in the news. But can we avoid all of that? Can the U.S. continue to have growth with one country after another starting to experience some slowdown? So I think we probably can actually. If you look at, especially in the Europe zone and even in Japan, their growth is pretty minuscule. Yeah. And so to slide into recession where you have negative growth is a lot easier for those countries. When you're only growing at 1% gross domestic product, I'm making that up, but it's easier to get down to negative than our 6 months was right around 4% for the last half of last year, and all those things. So we're a little bit of a different animal as far as that goes. So anyway, I think this has been a very fascinating week to kind of focus on what I consider the number one issue still. Even last year at this time, we were talking about it and saying, hey, it's not recession, it's the potential for increased inflation that probably is the biggest issue. I think if they keep rates up, for the year, they're going to be doing that, hopefully, because things are going okay.
Yeah, as long as, the economy is still growing and the job market softens only a little bit, they're going to keep rates the same.
Yeah, as a market participant, the thing that concerns me is that they kept rates down too long in the same basic Fed governor board and caused, that big jump in this inflation, or didn't get ahead of it, maybe didn't cause it, but it came in late. I think even they'll admit that at this point. And so then you wonder, hey, are they going to do the same thing on the other side? Because basically it seems like this Fed board gets on a roll going one direction, whatever that is, and it keeps going for too long. And so are they going to do it again, right? And are they going to, because, they can theoretically start to cut rates really fast, but it takes time for those, cuts to have impact. And if the economy's falling apart or if we're in a deflationary environment, And I do think that's one of the bigger concerns, and I happen to share that concern. I wouldn't be surprised to see the Fed kind of outdo themselves here, but I'm not sure that keeping the rates where they are for the remainder of this year is really what I'm talking about. It'd probably be more of what would happen in 2025. They keep it up for years and years, and things really get soft. But I don't know. We'll see what happens. But anyway, that's our summary for the week, for kind of what we saw happening in the market. Still a good week, another up week, I believe, and so that's all happening kind of like 95. So keep our fingers crossed, and we'll see how this goes. All right. Good. So what's our first question?
What is the medical and dental expense tax deduction? So, as tax season comes up, we get more and more tax questions.
Yes. Yeah, I've been asked this quite a few times, because, got an older clientele, they've got some medical costs, or maybe somebody's in, a home care or nursing home care situation, and it's actually pretty complicated. First of all, they've increased the standard deduction so high. It's at 27,700 for last year for a couple. And so in order to itemize, which is how you would get this deduction, you have to have more, expenses on that itemization. And if you don't have a mortgage or different things like that, you might not.
It's tough.
Yeah. And they also have another weird hoop to jump through with these expenses. You can only write off your medical expenses that are higher than 7.5% of your adjusted gross income.
Yeah, and so it's whatever's excess of that. So, so that's another hurdle. And then also, does your expenses qualify? So, if you go into nursing homes, if you don't primarily go into a nursing home for a medical reason, then you only can pay for the medical portion of that. If you go in because of a medical reason like Alzheimer's, like memory care, then the entire cost would then be considered deductible.
Yeah, so you have to verify whether the expense that you're trying to write off is a qualified expense that based on based on their interpretation. You and I might look at that differently and say, hey, this money's going out the door for for this person, but that's not how it works. So it's an important component, especially if you do have a lot of money going out for some type of medical situation. It'd be awful nice to get some of it back through a write-off.
Yeah, especially if you have a loved one that's in, maybe long-term care and they're spending a lot of money on that. This could be a tax deduction for them.
Yeah, it's a good question. This is the time of the year we're getting all these type of questions.
Should I be worried about inflation coming back or stagflation?
Okay, so inflation coming back is, probably my biggest concern. I don't know what's going to happen, but I feel like if I'm making a bet between, hey, we're going to slide into recession or have inflation come back, I'm leaning slightly towards having inflation come back, just based on what we're seeing, in the numbers and the strength in the economy, the employment situation, the different inflation reports that we're getting, et cetera. It's definitely not falling as fast as it was. So, does that mean it could come up? And of course, the market's up, so people feel like they can spend more money, and that creates another inflationary potential. And so stagflation is where you'd have inflation and basically very low growth, or even
the idea is
growth.
that your inflation is outpacing your growth.
Yeah, which is what happened in the 70s, kind of the last time we had this type of big inflation. We had this scenario with no growth but still had inflation, and it's a kind of a brutal scenario because both for consumers, for businesses, because costs are going up and your revenues aren't really, essentially.
And the way they broke it was basically breaking the economy.
Yeah, exactly. So we're not in that situation right now. It's inflation is down far enough at this point where we're not that far from the targets and kind of normal inflation, at least on the PCE core. So stagflation is a possibility, but not a threat in the immediate time frame that we can see. And so I'd probably be more concerned with the resurgence of inflation and watching for that, and watching all these different gauges of that.
Yeah, and we have to be seeing a trend. Right now, we saw January as kind of like a blip in the market. Is this going to be a continuation? Is there going to be a continuing trend, or is it just kind of just a fake out.
Yeah, exactly. Exactly. All right. What's our next question?
What are some reasons to take Social Security early?
What are reasons to take Social Security early? Okay, so uh, you need it for one thing, right?
Yep.
So, I remember seeing a stat: the average 65-year-old has $49,000, and not including their home, but just in investment assets, savings, those types of things. And so, hey, you don't have a job anymore, maybe you're 62, can't get another job, don't want to get another job. That might make some sense to take Social Security because you got to pay your bills, and you don't have enough money saved in the other areas. So that's a 58% of Americans take Social Security at age 62. That's got to be one of the reasons.
Yeah, and when you're looking at just a vacuum, kind of with no other factors, what is the break even? Taking 62 versus 70. Usually the break even's just in the 80s. So if your life expectancy for some reason, you have a medical condition and you don't believe you're going to live to your 80s, that's a good time to take Social Security.
Yeah.
Um, Most of the time we plan for a longevity risk, and so we're always concerned with outliving your money rather than dying early. So that's how we think about it when we come to planning.
Yeah, it comes from experience. We have a client that dies early. It's usually not a financial situation, because they've saved money theoretically, and the less time that they needed the money in the end. It's never a happy moment, but in terms of finances, dying early is easier from a financial planning standpoint, unfortunately. The real sad stories are, a conversation I had with this gentleman, and he took the last dollar out of his IRA, taking it monthly, and calls me up and thanks me and says, I lived a lot longer than I thought I would. So those are the ones that I remember. And, just going back to what my first client really was my grandmother, and my grandfather just passed away. She didn't have a job. She hadn't had a job for a really long time. She was only 65, and her comment to me constantly was, "Hey, just help me not run out of money," and that kind of really drove that home. So, oftentimes when I look at Social Security, that is one of the things I think about, is just making sure, But there are other reasons to take it early. So, if you don't think you're going to live very long, then you might want to. If you need it, obviously you take it. You also need to do an analysis. If you don't take it early and you are retired, you're going to be, drawing money from someplace.
Yeah.
And, what rates of return are you getting? How does that look? And so we run Monte Carlo simulation to say, okay, what happens if we take Social Security early versus late? And, how does that affect the assets overall? How does that affect the overall plan, in terms of the long-term aspects of it? And so that, that's very specific to your financial situation.
Yeah, it's like, when are you retiring? When are you pulling from your assets? Because if you take it at 62, you're giving about 30% of your benefits, compared to 67. So that's a big difference.
Yeah.
And if you take it 70 versus 67, you're getting 24% more.
24% more. So that's a big chunk of money that, again, still might make sense to take it early. We don't have anything against that really at all. We just look at the numbers, and we can test it in a vacuum. We can test it in a full-on financial plan with Monte Carlo simulation. We can get the right answer, at least from a number standpoint. And then it's up to just kind of somebody's thoughts and feelings about it and what they want to do. But I do think it's really important to have the number, so that you've got some idea. What age is the optimal age to take Social Security to maximize that for you? That comes from planning, not from just some random piece. And a lot of times we talk about some generic things, and we do some case studies with examples of plans. But your plan, it could be quite different. You have to be careful of those. If you're really interested, talk to us, and we'll put it in our plan and run it and see what the answer is.
Yeah, and there's kind of like a niche case that happens quite often, is when you have a big difference in ages with spouses. So say your spouse is 10 years older, there could be a reason for you to take early then, just based on the differences, and you'd have to do some sort of calculation with how much Social Security are you getting versus spousal benefit, but you could figure out a time where taking it at 62 may be an option.
Yeah, that's right. Yeah, we've seen those come up a couple times in some of our planning scenario where it's recommending that the younger spouse with enough age differential should take it early, and that optimizes the scenario. So again, we're kind of engineers in this regards, and just trying to optimize the cash flow as much as we can to make sure, again, to not run out of money. If you live a long time, that's a great thing. But it puts more pressure on your money.
So why did the 49ers lose, and how can I make up all the money I lost betting on them?
Well, the two biggies that stick out is Greenlaw's injury, right? Because man, actually they showed a picture of Patrick Mahomes when he saw him get injured. His face lit up a little bit because they could start attacking that middle of that field, because between Warner and Greenlaw, man, they are really they're fast.
Kelsey in the second half had a much better game than the first half.
Yeah, and I heard one announcer talking about the 49ers lineup is stars and scrubs, which is not an unusual concept. Spend a bunch of money on a bunch of really good players, don't have as much money for depth per se, and so the poor guy that came in took Greenlaw's spot, really got hammered, and I think there was 9 completions and 9 attempts, or some crazy thing, because that's the strategy, right? They always pick on it, and then they're really getting hammered for this, taking the ball in the overtime first, and it looks like they didn't know, and
there's been back and forth whether you take the ball or not. It is the first year that's really the rule.
Yeah, but I would want to know. Right? What if, because it gave Kansas City an edge to know.
Yeah,
you're going for it on fourth down
Yeah.
when they already got it changes at least that part. I think they tried really hard to get a touchdown. They almost got it. They were doing great, actually.
I think it's a culmination of multiple factors, because you could also say, they were unlucky in the game. They had a blocked extra point.
Yeah.
They had a punt that went off someone's back of his leg, and then they lost it.
That was really unlucky. Yeah.
They gave him a short field, and they scored a touchdown on that. That was, I think, the only touchdown they scored in regulation.
Yeah, that might be right. And it was such a freak little play too. So yeah, I don't know, but it was a good game. It was close in the spread, and it was a close game. Ended up being a tie in the regulation. Went to overtime, and I think it could have gone either way. But I don't know that I would have bet a lot of money on that game, because I couldn't figure out who's going to win.
Yeah. But when you bet, you always have to have the expectation: can I still be financially okay if I lose this money?
One thing I might start doing. Chris Berman has been right prior to the Super Bowl, 4 out of the last 5 times, and he predicted this Super Bowl be 23 for Kansas City and 20 for the Niners, and ended up 25-22. So he got the spread right, and it was really close to the score. Maybe follow Chris Berman next time. I thought that was pretty impressive, because I actually thought his prediction might be right in terms of who would win, but I thought the score might be higher.
Yeah,
but
I thought it would be more of a shootout style game, not a defensive.
Yeah, it really was kind of a defensive battle in the end. It was a good game. All right, I got a question that I want to answer just off the cuff here, because I keep getting asked pretty much at every appointment. I'll ask people, go over the accounts, I'll go over the market and I say, hey, do you have any questions about your accounts, the stock market, the economy, what have you? And the question that comes up, I can almost predict it now, is just, will this election affect the market? Right, over and over I've been asked that, and I know we've covered this before, but I'll just cover it again, because I think it's kind of interesting. If you look at past elections, they haven't had a significant impact on the stock market.
Yeah, 3 of the 4 election years tend to be a positive year.
Yeah, no, this is a crazy election and all these things, but we've had some crazy. I mean, the market went up on January 6th during the middle of that insurrection. It was up on January 7th the next day after people would think about it. And so here's the thing that I think is really important that I've learned, is that you have to consider every event that might happen with how it can impact company earnings. Okay, so if they invade the Capitol, or whatever you want to call that, does that impact company earnings? No, and it didn't, right? In the end, so whoever wins, the presidency, they can have some impact over the longer term on company earnings.
Yeah, you can think about Chinese tariffs as an
Yeah,
example.
yeah,
Well,
yeah.
they did an executive order, so bypass Congress,
Right.
and you can see how that's just affected, just importing into goods into the U.S.
Yeah, in 2018, they were going after the Chinese tariffs, and the Federal Reserve was raising rates at the same time. And the market dropped 20% until they finally figured out that, hey, these two things are doing the same thing. They're bringing the economy down. They started lowering rates in 2019. We had a great year. And so yeah, there's other things too. I think the big bill that was pushed out for COVID relief right after Biden became president, 1.9 trillion went out. If you look at the inflation charts, it started right after that,
Yeah.
and they funneled that money out to people who needed it. And they, if you're living month to month and paycheck to paycheck, and somebody gives you some money, you're probably going to spend it. If you're super wealthy, you probably just put it in your savings
Yeah.
account or your investment. So when they start giving money to that group, they're spending it. Of course, that caused inflation. We did end up with a 28% drop in 2022 from high to low because of that. So there are some things that can happen, but all of those scenarios we just talked about happened quite a bit later than the actual election
It
itself.
takes time to
Yeah.
actually get these policies in or any
Right.
kind of thing to be
Right.
pushed through Congress.
Yeah. So at this point, you just kind of wait and see what's going to happen. But I wouldn't be too concerned about, the election itself being an impact on the market. There's too many other things. It really, I'm much more concerned with what Chairman Powell is going to do at the Federal Reserve than I am with who's the president, at least from the stock market standpoint. There's other issues besides money and besides the stock market, but obviously that's what we're talking about here.
So I have some extra cash flow. Should I invest or pay down my 6% mortgage?
Huh. So 6% mortgage, right? So that you said 3% mortgage. That's a different story. You stay 6. You're starting to get up there. Vanguard had a piece on risk return, and it went from like 1926 to 2019 or something. And I think a 60-40 portfolio was right around 8.3% or something. So and that's not guaranteed, right? That's long-term return. You're guaranteed to have to pay 6. So those get to be very equal to me very quickly. So it's kind of interesting as to what you would do.
So it's like you start to think about, what's your age? Say if you're in your early 30s or, your 40s and you're looking at this money for retirement or past retirement, you have a long time horizon. So you can be a little bit more aggressive. But if you're in your 60s and 70s, you may be more conservative and look at that mortgage, paying down that fixed cost.
Yeah, exactly. Because I mean, if I'm young and I've got 30 or 40 years for this money to grow, I'm probably going to get that average at least, and that average is higher than the mortgage. And if I'm older, I maybe don't have that long term. I could be facing a scenario like 2008 where the market dropped and took 5 years to come back, and all of a sudden I'm 80. I wish I would have paid down the mortgage, right? You can also split the difference. If you got excess cash flow, to me that means it's coming in monthly, right? You can push some of that cash flow towards the mortgage and some of it towards the investment. And I think that diversifies the scenario because heck, the investment world could go crazy. We could have 10, 15, 20% returns, which has happened.
Yep.
Or it could do terrible, right? And so kind of splitting the difference, almost no matter what age you are, is not a terrible reason either. But if I'm younger, I'd probably split the difference more towards the investment side, less towards the mortgage. And if I'm older, I'd probably do just the opposite.
Yeah, and also, what's your personality? What's your risk type? If you're super conservative, I'd take the mortgage then. If you're super aggressive and you like the stock market, go for it then too. You also have to fit yourself too, in a sense.
Yeah, the math doesn't work out perfectly, but in a way, you're kind of guaranteed a 6% return by paying down your mortgage, and that's not a bad guarantee. That's why I'm saying 6% is kind of that. If it was 3%, that's different, because it's such a low amount of payment versus what you could make someplace. But yeah, exactly.
And then also another thing that you could consider, another factor, is how much are you already investing right now? If you're investing a ton of money already, maybe it's okay then to take some guaranteed returns then by paying down your mortgage.
Yeah. It's a good question.
Yeah, the answer really depends on your situation's factors where
I
you can
think
make a
so.
really good
Yep.
recommendation.
Yeah, that's what it comes down to in the end, right? When it's a kind of a coin flip answer, what do you want to do? What feels good, right? I mean, I always factor in, kind of feeling. I love to know the numbers. I love to know the facts, but I am more than willing to accommodate a client's kind of desires because life is short, and really, making sure that you're happy with things.
And a lot of things with money is no matter how different the numbers are, your emotional state will always kind of could be the same.
Yeah, and there's nothing wrong with that. They got to balance it on both
Yeah.
sides. You can't just be completely numbers oriented and have a miserable life because you're not doing what you want to do. You can't be so unfocused on the numbers and the facts that you end up in a hole somewhere. That you didn't know how you got there. So find that middle ground.
So when my child inherits my estate, does it become communal property? Is it shared between her and or him and her spouse?
So yeah, I was just thinking about because we have a couple situations where basically, we recommended that they keep the money separate in their name, right?
Yep.
And so they inherit it. It goes directly to that child. They're married. Keeping it separate makes it non-communal, right?
Yep.
And so once that moves into joint accounts, so I mean that means it's communal at that point in time.
Yeah. So essentially, inheritance is considered a separate asset. So if you get inheritance while married, it's considered the person's asset. And so in a divorce proceeding, inherited assets are protected unless they're for some reason become a communal property.
Yeah.
So let's say as you get inheritance and you buy a house together. The house is a community property, therefore your inheritance is used for community property, therefore it becomes a community.
Yeah, and there's nothing wrong with that. I mean,
No.
honestly, but just to know what you're dealing with, I think is important. It's a good question, and so again, I've seen all of it. I've seen people just dump it into joint accounts or trust accounts. I've seen them keep it separate. There's nothing wrong with either one of those as far as that goes. But once you put it into that, joint or scenario, whatever that might be, then it's joint money at that
Yeah.
point.
What are realized gains?
Realized gains. Okay, so there's two main categories of gains, capital gains in this particular case, I would assume. And that is, unrealized, which just means that, hey, I paid $10 for a stock. It's now worth $100. I have a $90 profit on that stock per share. Sounds good. And but I didn't sell it yet. So it's an unrealized gain.
Yep.
Once I sell it, it becomes a realized gain. I don't have to pay taxes in this case on that 10 because I already paid taxes on that. But I do have to pay taxes on the $90 per share gain that I had in that scenario. And so that's a realized gain. And it's kind of fascinating to look at the accounts, when I'm doing my reviews with the clients and see, how much money is in there that's unrealized gains. It's really kind of fun. And what really matters, though, like this time of the year is what's realized, right? Because that's what ends up on your tax return. Now, you can have these things happening inside your IRA or 401k. It doesn't count. It doesn't matter. You don't have to pay taxes. You can pay $10 for a stock inside of an IRA, sell it when it's $100. Because it's in the IRA, it's sheltered.
Yeah.
You'll only pay that when you pull the money out of the IRA directly, or when you're forced to after 73 for the required minimum distribution. So it's a good thing to have gains. Although I always get a lot of questions from clients around tax time because it means they have to pay taxes on those gains. But again, it's better than losses.
It's kind of like a first world problem. You made money, and now you have to pay a portion of it as tax, and it kind of sucks. But thankfully, you made some money.
Yeah, and one thing that does happen if you're married and you have it in a joint account or trust or whatever. If one person passes away, they step up the basis. So if you paid $10 for that stock, it's worth $100. When that person passes away, your basis moves up to $100. So if you did sell it, then you wouldn't have the tax, right?
So there's some decision making whether I hold this asset for a long period of time, wait for a step up, or do I just take my gains now and then maybe it's underperforming. Then you kind of think about taking the gains now and then reassessing it.
I have a number of clients that that's they're stated and they're okay with it, because the same thing with houses, they got a house, they kind of want to move, but probably just they're literally telling us they're going to wait until one of them passes away so that they can sell it without the tax and then move, and so it's kind of a weird conversation and strategy, but it's how the step up works as far as that goes. So that's a piece of the conversation about whether we should be realizing gains or not. Sometimes we want to realize the gain because we feel like the holding is going to fall apart and we want to move to something else. Sometimes we're realizing a gain just because somebody needs money. They need to sell that piece to get some money out. So we try to avoid them as much as we can, but they're not a terrible thing.
So, what's a custodian, and how does it differ from the advisory firm?
A custodian, advisory. Okay, so custodian in our case would be somebody like Charles Schwab. We were with TD Ameritrade, and they merged together, but those are both custodians, and they basically hold the assets. They produce the statements. They execute the trades. We're constantly, Marie and Teresa here anyway, are constantly talking to Schwab. Account changes, address changes, all of that stuff is done. Issuing the checkbooks out of the IRAs or other accounts, all comes from, in this case, Schwab, and the Fidelity is another custodian. And they're probably the two biggies, right? And so that that's their job. And the advisory firm, which is what we are, right? And there's lots of advisory firms out there. There's different types. We're a fee only type advisory. There's different types, but nonetheless, we don't make the statements. We don't hold the money. Well, we have had kind of almost comical situations with people coming into the lobby, wanting to withdraw like cash, like a bank. We don't have any cash. We don't have any of that. That's at the custodian.
Essentially, we help facilitate the investment decisions, stuff like that, and we kind of help manage it, but we don't actually own the accounts in a sense.
Yeah, so we're in charge of, and in our case, we have discretion on our accounts. We're in charge of managing the asset, to the client's expectations and risk level, right? Suitability and all those things that, we're fiduciaries. We're held to a standard that says we need to do things for the best interest of the client, not the best interest of us, right? And so, but we're kind of the go-between. So you could go directly to Schwab yourself, and you could be calling them like Marie and Teresa are all the time, or you just kind of let us know, and we do all the work and get all the things, and some of it can be quite arduous, actually. And so that, we're facilitating with the custodian, and we're obviously, helping with the money management. Now, on top of that, and this is just more, not so much a connection between the custodian and advisory firm, is all the financial planning advice that we do. Analyzing somebody's long-term care policy, or taking a look at their Monte Carlo simulation and their plan, or finding out the maximum age to take Social Security. What's the best age? These are things that we're doing as an advisory firm. That's not what a custodian would do, right? Custodian is just there to kind of execute and produce those statements and, confirmations and those types of things. I think it's a nice relationship, because honestly, I don't think, in my opinion, you want your advisor to have direct access to your money. I think that's how Madoff got away.
They have to be quite a big operation to have the capabilities to do that.
Yeah, it's but I think that separation of kind of the advice and the money in that regards, I think it's a better scenario. I would almost never invest in a scenario where my advice and my money were at the same place, personally, ever, because that's where some of the biggest frauds have come from, whether it's a hedge fund, right, or like what Madoff did, for example. So I like the separation. I think that creates, because look, you can go to Schwab directly and look at their portal and see what we're doing, and we have no control over that portal. We can't fake it or do anything with it or anything like that. And a lot of these frauds is what they're doing is they're faking everything, So, and that's we want to watch out for that. So I think there's some importance to understanding the difference between custodian and advisory firm, just in terms of how frauds are perpetrated and the way that, the separation, I think, is much, it makes me more comfortable personally. All right, that's the end of our show. We even got in a 49er question, what do you know? And so I want to thank everybody for coming today. Really, really good session today. Great questions. Send your questions in again now. Send them to asktom at talkmoneywithtom.com. Give us a chance during the next week to kind of come up with some, ideas on the answers and such too. It'd be great. And of course, you can always, subscribe to the channel and hit the bell button, because we're putting out new content all the time. Continue your education in this area. We try to make it pretty palatable. I put out a couple-minute video every day. The market's open, Monday through Thursday, because we do the summary on Friday. But and so you can get that and find out, what our thoughts are, what's happening in the market. And of course, if you want to meet with us, you can do that too. Just hit the, yellow button looks just like that on top of our webpage, and set up a time to meet with Lisa and I, and we'll discuss your specific issues. So thank you very much for coming today. I look forward to seeing you again next week.